Good afternoon, everyone. My name is Jeff Feinstein, Managing Partner of Pinnacle Partners. Pinnacle is a leading provider of opportunity zone real estate offerings. We've been executing exclusively on the legislation since it was enacted in 2017. Throughout the firm's term, we've capitalized close to $1.5 billion of multifamily housing, and we work very closely with a select few RIA wealth advisor partners. Those partners that are seeking tax efficient alternatives, and those partners that have sophisticated strategies, particularly for those clients that have low basis concentrated stock positions. They may have a major liquidity event, sale of a business, sale of real estate assets, generating capital gains. And so 3Bell has been our trusted partner for now several years as they invoke this strategy and also offer our opportunity zone offerings for consideration for tax advantage diversification. We've been having this conversation with Steve now throughout the year, and we're checking back in mid-year. Steve, welcome back to our series, and if you would please make another introduction to the audience, 3Bell and yourself.
Yeah, Jeff, it's great to be here. Thank you for having us back. 3Bell is an independent wealth advisory firm based out of Los Altos, California, kind of the heart of the Silicon Valley. And as such, the majority of our clients are founders, entrepreneurs, or successful executives who have simply received and been compensated with a lot of equity comp over the years. Many times, what was never intended to be a concentrated position through the success of their own efforts and collected from their companies, they've oftentimes suddenly found themselves in a position where that single stock controls most of their portfolio weighting. And so a lot of what we do with those clients is just to help them walk through considerations, what their options may be, full pun intended, and really just help them to guide that conversation and to help answer that question of what am I missing? What should I be looking at? Is there anything new? Is there anything I should be considering? But 3Bell was founded back in 2010, really coming out of the great financial crisis. And as we all remember back then, the most sophisticated, well-diversified portfolios, there wasn't many place to hide until you started to look outside of the world of stocks and bonds. It's simply a world that we call alternative investments. And so through that, what we found is that our clients really look to us for guidance, both in strategy and investment deployment. So we're happy to be here. We're happy to have successfully worked with Pinnacle and look forward to the conversation.
Excellent, Steve. Well, we got together in quarter 1. We have a new incoming administration. We had concluded the year, NASDAQ was up, I believe it was 24%. You and I talked about, would there be reversion to the mean? I now show a chart of the Qs, and let's see if we had that conversation. I guess it was here in quarter 1. Again, market was at highs, but as we well know, post Liberation Day, there was a significant drawdown, and there's been significant volatility throughout the year. As we look forward to the balance of this year, we still have a number of catalysts that will likely continue volatility, to include the expiration of the 90-day pause of the tariffs, the so-called big, beautiful bill, the tax cut bill, and an eventual legislation sometime July, August, and of course the ever-present Fed and their position on rates. So we've seen some, extreme volatility. I'm not asking you to prognosticate for the future, but I guess we should talk about how to navigate this volatility. So, Steve, what have you been advising clients more recently, and as you look forward into the balance of this year?
Yeah, I think that the farther back that 2024 gets in the rearview mirror, the more and more it begins to look like a bit of an anomaly. 2024 was a very low volatility year outside of only a few, in early August, we had a big disruption from the Japanese central bank, suddenly raising interest rates to slightly more than the market anticipated, led to a 10% S&P 500 decline, one of the sharpest rises in volatility on record, followed by one of the sharpest declines of volatility on record. When we saw markets continue to ramp higher, and then another little blip on the radar there in December following a Fed meeting. And as we headed into this year, as you look kind of back towards, I think if you're a student of market history, you would observe that periods of very low volatility are frequently not followed by more periods of very low volatility. So while it remains to be seen how and what's going to happen, I think that what we did see from late February through early April, through the market bottom so far, I think that it's safe to say that there have been new risks and new considerations introduced to markets that simply weren't a thought last year, and something that should begin to open up investors' viewpoints and should, likely encourage a conversation, especially as you look back over the time frame from February through April. It's very possible that it happens again. It always looks a little bit different. But if that was bothersome to your, when you looked up, open your statement or your portfolio and you didn't like what you saw, now is kind of that time to possibly revisit that and look back and say, well, if I didn't like that and I'm not as optimistic about the future for this company or for just public assets in general, maybe that's the thought process that could have brought you to this video today. It's certainly one that may warrant that conversation.
Very good, Steve. And so at Pinnacle, executing the Opportunity Zone legislation requires the investment of a long or short-term capital gain from any source. So you could sell low basis stock, you could sell your primary residence, an investment property, you could sell crypto, or generate carried interest as at your venture or private equity firm. Any source the IRS designates as a realized capital gain qualify for these extraordinary tax benefits. We won't go into great detail on the tax benefits. Suffice it to say, it's a tax shield. So if one is considering strategies maybe to reduce concentration, to obtain diversification, of course, our partnership has led to this sort of pair trade of your sophisticated strategies to call or hedge or other option strategies, derive a capital gain, plan sale, reduce that concentration, and then allocate to real estate and use the tax shield as that gateway to do so in a tax efficient manner, not only with the incoming gain, but ultimately, as we know, there's tax elimination associated with Opportunity Zone investments. So maybe talk about some of those discrete strategies you advise your clients if they have, as an example, NVIDIA stock, they're an employee or maybe a long-term investor.
Right. It's been a conversation we've been having a lot. And NVIDIA, I think, is one of the great American stories. And it's certainly been one that has come up upon us pretty quick. So I think a number of our clients have been very excited, but also a little bit nervous, where they like what they see when they open up their portfolio. So it begins to kind of, in our belief, there is never an all or nothing conversation. There's never a point that you look back and say, well, this is the absolute time to sell. And that's really where that conversation starts, is what that is helping to derive what that runway is going to look like. And to help clients, as we say, get from point A to point H, which is to go from a portfolio that is solely one concentration or a primary concentration of a one stock, whether it be NVIDIA, Google, Amazon, and predominantly a lot of the names that are located geographically in our area, but really across the country. There's been a lot of great performing names, and We look at this as a challenge, right? Where how do you go from that point A to point H? And we call that point H because it's not meant to be the end of life, the end of retirement. It's just meant to be a stepping stone into what's next to help clients get from that concentration in what we call a destination portfolio or a portfolio that's built and designed that has your needs in mind, that has the return characteristics and the risk characteristics that clients are comfortable with staying with for the longer term. It's always a stepping stone to get there, but the way that we typically will work with clients is to help them build out a multi-year strategy for taking advantage of what's right in front of them. It could be tax benefits, it could be an attractive price for an exit on their stock, but helping to make sense of that really in a three-dimensional picture so that how do we know what a good price is to potentially exit that position? And then most importantly, is simply that we don't think it's a good idea to just simply exit a position, go into cash with a large tax liability. So being able to help create that destination portfolio is a big start, and it's a very important conversation. But as we kind of look and go into that a little bit deeper, right? Does it make sense to go from a name like Nvidia, which is jockeying for position for the top spot in market cap between Microsoft and sometimes Apple? Does it make sense to go from an S&P 500 stock back to the S&P 500 to try to achieve diversification? It certainly didn't work very well through February through April. So what our belief typically is to consider that initial step to that destination portfolio, looking at non-correlated assets, looking at investments that not only have a different risk parameter to them, but that are sourcing their returns from something that doesn't require the market to do one thing or another. And so being able to kind of build out that multi-leg layer of a stool, or as we like to say, if your portfolio is an elevator, having more than just two cables on it, having more than just stocks and bonds, understanding that if both of those break, like we saw in 2022, and like frankly, we didn't see much from bonds here in April, is looking towards other assets and other asset classes, particularly so in that alternative landscape, as the qualified opportunity zone investments are typically going to fall. So we think that's it's a helpful place to start, and one that there are no right or wrong answers. It really comes down to what that particular client's outlook is for their own stock and kind of what they're looking to achieve for their portfolio, their family, or their future.
And so we talked about, and I think it's a fair assumption that volatility will continue. I mentioned some of the upcoming catalysts we shall see. And so when there's a lot of vol, I assume the option pricing improves. I mean, maybe for our audience, just talk about taking advantage of vol. So we first recognize we'd like to reduce concentration. We may have a point of view from a timing perspective. It could be pre or post earnings or other conditions. But are you seeing the options market price accordingly? And is that to the advantage of your clients?
Very much so. The options market is always going to be a market that is reflective of the expectations of sentiment, volatility, of fear, of greed, effectively all at the same time, especially when we get these large, large expansions of volatility as we saw in the last few months. In our point of view, volatility equates to opportunity because volatility works in both directions. And so what that can be very helpful for is that if you've just seen a stock decline, as we did with a number of most of the more prevalent names here in the last few months, when we typically see those rebounds, remember, can happen just as sharp, just as short, just as sweet. And what we tend to do with those rebounds is to begin to look at what an appropriate exit price could be. knowing that as markets decline and they begin to rally, and we've seen here for the past few weeks that the rally wants to continue just as if it never had stopped in the first place. And so as we see stocks begin to rally back up towards or even into all-time highs, that begins to really set for that conversation that says, well, if you would have gone back in history and said, I wish I would have sold here. Well, if you got that price again, maybe it's time to revisit that, knowing that what we're not likely to do, and I think what our collective opinion is that we're not likely to see a sudden surge of volatility and then a continuation of more like we saw last year in 2024, which is that all stocks go, as we like to say, from the lower left to the upper right on the chart. So volatility is an opportunity set from our perspective, and depending on the source of a concentrated position, if you're still employed with the company that you work for, you may be restricted into some of the considerations from what we call our concentrated position toolkit. But nevertheless, that's part of the conversation we want to have. And if you are restricted from participating in any type of option market volatility, then simply looking at how that translates to stock prices may be the most valuable thing for that particular client at this particular time, especially as we head into a summer that has a lot of unknowns, a lot of the tariff talks that have been somewhat sidelined. We don't know when they're going to come back. We don't know how they're going to come back, but it does maintain that if that, again, kind of reiterating what we mentioned earlier, that if you didn't like what you saw and how you felt, especially when it was something, an external stimulus that was impacting your stock price and not necessarily the success of your own company, that begins to trigger that conversation as well as to do I feel comfortable with this, or is it time to even consider, even a small allocation shift. Could be 5 or 10%, but those 5 or 10% position changes tend to add up over a period of years that we think is all part of that very valuable conversation as we help clients to kind of take set a roadmap for where they want to head next.
One of those, you talked about the summer of volatility, and as I mentioned previously, one of those items and potential catalysts is the legislation of the 2017 tax and job cuts, the extension of those tax cuts, and by the way, the renewal of the opportunity zone legislation. So something we call and has been marketed as OZ 2.0, a wildly successful program, really fulfilled on the economic objectives of redeploying capital in a tax efficient manner. And in our case, building more housing, much needed housing in targeted urban markets. There is draft legislation to renew the OZ program that would, as you recall from the early days of OZ 1.0, had a 7-year deferral and a step up in basis and the use of depreciation, which, by the way, bonus depreciation will be reinstated, and then ultimately tax exemption. So we're tracking this very closely. We're trying to influence policy, and we're extremely confident that we will see a draft of the Senate initiated amendment to the House bill where OZ 2.0 framework was devised. So we're looking forward to that in the summer, and we think that's a start of a brand new kind of wave of OZ investing. Steve, maybe as we move to close here, and you've given the audience some really good things to consider and strategies specific, maybe talk about your allocation, this kind of ballast potential for one's portfolio when including real estate broadly, and then you can opine on the tax advantages as your clients have enjoyed them through the execution of the program.
Yeah, I think it's a very interesting program that's seen a lot of success here since its first launch in 2017. And I remember being around and thinking this has got to be one of the biggest gifts and one of the biggest
Yeah.
advantages that has been awarded to those with concentrated positions. And eventually came to light that this was directly designed for those types of people. And we think back to how things were in 2017, and we there was certainly a dominance of tech that was prevalent in markets. But fast forward here, even since 2020, the S&P 500 has become so top heavy in tech, and rightfully so. But now the potential for that, the problem that QOZ legislation was, we think, really designed to kind of help alleviate that concentration risk. It's more prevalent now than ever. And so we're excited to have what appears to be an administration that's very real estate focused, that has quite an affinity for real estate. But as we look at kind of building out that destination portfolio for our clients, really look at kind of an order of operations type of approach, where if you want to build a puzzle, right, you start with the corners first. At least most of us do. Um,
Hmm.
and when you look at that and you try to find pieces of a portfolio that are going to look and feel very different, and again, that's really coming from twofold. One is which it's a different risk, right? Real estate and investing is more often than not a completely different risk set than investing in public equities. But on top of that is the return set as well. So where those investments generate a return source from, you think back over, many periods of U.S. history when stock markets were flat or somewhat neutral, and you had great real estate markets. So there are times where both go down, there are times when they both go up. But in terms of finding those non-correlated pieces, they can usually be a very helpful place to start. And then as we're kind of navigating that three-dimensional challenge, right, is how do you move all these moving parts around, is one of the big, aspects that we also want to consider is, well, what tax benefits are out there? What is some low-hanging fruit that clients can potentially look to take advantage of? And so when you combine those two, the QOZ conversation is often one that we like to start with, because you kind of get that, kill two birds with one stone, or insert your own metaphorical phrase there. But it begins to be a conversation that begins to say it's a very appropriate place at least to look. And as we begin to build out that destination portfolio, it's beginning to build those puzzle pieces around there, so that we're looking to both achieve a non correlation, a diversified portfolio, but also one with significant tax benefits and tax impacts. And as you start to look through, we call it our concentrated position toolkit. But as you start to look at all the available types of strategies and the benefits, the trade-offs, and really how to construct that, that's where I think the most value is had. There, you will never know if it was the right time, if it was the right thing to do, until you look in the rearview mirror. But we generally apply this with starting off with a dual rule set. Step one is you've got to like the price that you want to exit your position. Just as any good entrepreneur would, or any good business owner would, before you ever sell that company, you want to make sure that you're getting what you think is an appropriate value. And that can come from a number of different ways. But when we're looking at public equities, we're typically looking back at using technical analysis, using fundamental analysis, and a historical study of trend that's going to tell us and help to give us that roadmap that says, is this a good price? And if it is, at what point do we want to take action? Once we have that good price, we always say that it's our belief that you should never consider any sale until you have a destination portfolio in mind. Because the absolute worst thing I think we've seen with our clients over the years is if you make the exit and you incur a tax liability and you go to cash, and then the market continues to run, market continues to appreciate despite whatever risk may be out there. you've not done yourself you've done yourself a big disservice because you've diversified, but into a somewhat of a returnless asset. And so we always think that part of the early steps are to have really those two pieces very well documented and very well laid out to begin to number one, have your target price, have your target time, whatever that's going to be, and then begin to build out those cornerstones of that destination portfolio, and then continue to evaluate and continue to make adjustments as needed. As we know, the world is full of change. Markets are certainly follow that pathway as well. So, and as there is new legislation, as there are new rules, as there are new benefits that become more concrete, I think that even furthers that decision-making process to be able to help with the ultimate goal of making confident decisions that you'll look back on in a couple of years and say, yeah, I did the right thing. Even if the stock kept going higher, did I do the right thing by taking the opportunity that we had at the time and making a good educated decision and a good educated plan for your wealth and the client's family's wealth.
Well, Steve, this has been fantastic. I'm really glad that we can continue the conversation with you and work so closely with you and your colleagues at Three Bell on this pair trade as we've described it. You can be reached at Steve at three, that is THREE hyphen bell.com. So we certainly encourage anyone that has questions or want to pursue a deeper discussion, they reach out to you. I can be reached at Jeff at pinnacleoz.com. We will be providing breaking news on the legislation as we get yet another version of the Senate version. We'll apprise you, Steve, of course, real time, but we'll probably come to the market with an updated video on OZ 2.0. And then I fully expect you and I will be back together maybe after the summer, and we'll take a look at what the volatility was like, what moves you made, and then we'll think about quarter four and maybe some planning for 2026. So, Steve, thank you as always. Very thought provoking, and we really appreciate your time and look forward to our next conversation.
Thanks a lot, Jeff. It's good to be here. Look forward to it.
Bye bye. Thanks, everyone.